Stock market trading. Level 1. Trading arbitrage. Arbitrage in stocks. Arbitrage is the simultaneous purchase and sale of stocks to profit from an imbalance in the price. It is a trade that profits by exploiting the price differences of identical or similar financial instruments on different markets or in different forms. Arbitrage exists as a result of market inefficiencies and would therefore not exist if all markets were perfectly efficient. Arbitrage occurs when a stock is purchased in one market and simultaneously sold in another market at a higher price, thus considered to be risk-free profit for the trader. Arbitrage provides a mechanism to ensure prices do not deviate substantially from fair value for long periods of time. With advancements in technology, it has become extremely difficult to profit from pricing errors in the market. Many traders have computerized trading systems set to monitor fluctuations in similar financial instruments. Any inefficient pricing setups are usually acted upon quickly, and the opportunity is often eliminated in a matter of seconds. Arbitrage is a necessary force in the financial marketplace. A simple arbitrage in stock example. The stock of company X is trading at $20 on the New York Stock Exchange, while at the same moment it is trading for $20.05 on the London Stock Exchange. A trader can buy the stock on the New York Stock Exchange and immediately sell the same share on the London Stock Exchange, earning a profit of 5 cents per share. The trader could continue to exploit this arbitrage until the specialists on the New York Stock Exchange run out of inventory of Company X stock, or until the specialists on the New York Stock Exchange or London Stock Exchange adjust their prices to wipe out the opportunity. A complicated arbitrage example. Though this is not the most complicated arbitrage strategy in use, this example of triangular arbitrage is more complicated than the previous example. In triangular arbitrage, a trader converts one currency to another at one bank, converts that second currency to another at a second bank, and finally converts the third currency back to the original at a third bank. The same bank would have the information efficiency to ensure all of its currency rates were aligned, requiring the use of different financial institutions for this strategy. For example, assume you begin with $2 million. You see that at 3 different institutions, the foreign currency rates exchanges are immediately available. Institution 1, Euros to US dollars equals 0.894. Institution 2, Euros to British pounds equals 1.276. Institution 3, US dollars to British pounds equals 1.432. First, you would convert the $2 million to euros at the 0.894 rate, giving you 1,788,000 euros. Next, you would take the 1,788,000 euros and convert them to pounds at the 1.276 rate, giving you 1,401,254 pounds. Next, you would take the pounds and convert them back to US dollars at the 1.432 rate, giving you $2,006,596. Your total risk-free arbitrage profit would be $6,596. Yet another example of an arbitrage in stock opportunity. TD Bank trades on both the Toronto Stock Exchange and the New York Stock Exchange. Let's say TD is trading for $63.50 Canadian on the TSX and $47 US on the New York Stock Exchange. The exchange rate, US dollars to Canadian dollars, is 1.35, which means that $1 US equals $1.37 Canadian. Given the exchange rate, 47 US dollars equals $64.39 Canadian. Clearly, there's an opportunity for arbitrage here, as, given the exchange rate, TD is priced differently in both markets. A trader can purchase TD shares on the TSX for $63.50 Canadian, and sell the same security on the New York Stock Exchange for $47 US, netting them 89 cents Canadian per share for the transaction. If all markets were perfectly efficient, there would never be any arbitrage opportunities. Markets seldom remain perfect. It is important to note that even when markets have a discrepancy in pricing between two equal goods, there is not always an opportunity for arbitrage. Transaction costs can turn a possible arbitrage situation into one that has no benefit to the investor. For instance, consider the scenario with TD Bank shares. If the trading fees per share or in total costs more than the total arbitrage return, the arbitrage opportunity would be erased. Summarily, arbitrage in stocks is the simultaneous purchase and sale of stock or securities, commodities or assets in order to profit from price discrepancies with as little risk as possible. Please note that an arbitrage requires more than one transaction or leg. The price discrepancy does not necessarily ensure a profit. The risk may be quantified as being low, but it does exist and can lead to significant losses. Here are some popular forms of arbitrage. Risk arbitrage. When one company seeks to acquire another company, there is a discrepancy between the deal price offered by the acquirer and the market price of the target company. In the event of a stock-for-stock deal, the arbitrager will buy shares of the target company and sell shares of the acquiring company, a ratio to equal that of the proposed transaction. In the event of a cash-for-stock deal, the arbitrager will buy shares of the target company and borrow money to finance the transaction. As a result, when a new merger and acquisition deal is announced, the target company's shares will rise as the acquirer's shares will tend to fall. The risk. The acquirer walks away from the deal. This can occur because of material adverse changes, such as what happened when the Harman International acquisition fell apart, or because of the loss of financing, as occurred with Blackstone in its attempt to acquire PHH. Sometimes the deal falls apart for other business reasons, such as what happened with the Tell Labs acquisition of Sienna about a decade ago. That broken deal cost long-term capital management a bundle. As you can see, if a deal falls apart, it can result in significant losses for the arbitrager. To give you a little perspective on the magnitude of the risk-reward trade-off, typically the arbitrager will gain 3% to 5% on the transaction. But if the deal falls apart, the arbitrager can stand to lose 20% or at times more. Index arbitrage. One can buy all the stocks in an index relative to the value that is implied in the market price of the futures contracts underlying that index. The arbitrager will buy all of the stocks underlying the index and sell the futures for the index. In the process, the investor will borrow money to buy the stocks, pay interest on the loan, and earn dividends on the stocks. As such, the perceived profit is equal to cost of stocks plus dividends on stocks minus interest costs minus futures values in this example. If the interest rates increase or dividends decline from their anticipated rates, then the perceived profit will erode or potentially turn to a loss. Carry trade. This involves borrowing money at a lower interest rate and reinvesting it at a higher interest rate, earning the differential in interest rates along the way. This can be done in the foreign currency markets or may also be performed in the bond markets. In the forex markets, the investor would buy a high interest currency and finance that with the selling of low interest rate currencies. As an example, in the bond markets, one would sell the 2-year Japanese government bonds at a yield to maturity of 9/16%, convert the Japanese yen proceeds into US dollars, and then buy an equivalent amount of 2-year US Treasury notes with a yield to maturity of 2%. In doing so, the investor would be able to earn 1 7/16%. When the bonds mature, the proceeds of the 2-year US Treasury is converted back to Japanese yen and used to refund the JB maturity. The US dollar Japanese yen exchange rate changes such that the investor has to purchase more expensive Japanese yen when the transaction unwinds. To combat this, one might be inclined to buy a forward forex contract to eliminate that exchange rate risk. However, doing so might eliminate the entire perceived profit. International arbitrage. When foreign-based companies issue stock in their country, these are referred to as ordinary shares. In order to allow investors in other markets, such as in the United States, to have ownership in one of these companies, the company will issue American depository receipts, or global depository receipts. As a result, from time to time, a spread or differential in pricing will occur. This spread allows investors to earn arbitrage profits. The strategy. The arbitrager will buy the ORD shares and short sell the ADRs, or vice versa, depending on their relative valuations. In order to determine which is rich and which is cheap, you need to recall the pricing formula for ADRs. ADR theoretical share price equals ORD share price multiplied by the conversion ratio of ORD share price to ADR shares multiplied by the foreign currency exchange rate. For example, shares of BHP Billiton ORD shares closed at $36.91 Australian on Tuesday, February 12th, in trading on the Sydney Exchange. The forex rate was $1 Australian equals 0.9035 US dollars. There are 2 ORD shares for every BHP Billiton ADR, so the theoretical value of the ADRs going into the US trading day was $66.70 per share. BHP closed at $65.84 the day before. Thus, if you owned BHP shares, then you would seek to short sell BHP in the US if the shares rose above $66.70. Once again, there is inherent risk in forex rates. Since you have to execute different legs of the strategy in 2 geographically different markets, which might not be open simultaneously, then you have to face market risks that result from the time differential. Furthermore, since there are operational costs for converting ADRs to ORDs, sometimes ADRs will trade at a normal discount to the ORDs, and the perceived profit is actually a permanent discount. Finally, a successful short sale may be difficult to achieve. Either the local markets severely restrict the shorting of ORDs, or the availability of ORDs for stock borrowing may be limited, or so costly as to further impact the perceived profit. Convertible arbitrage. From time to time, corporations will issue debt that is convertible into shares of the issuing company. By doing so, the company will pay an interest rate that is lower than which would be paid on non-convertible or straight debt. Convertible debt is a hybrid security that is comprised of a straight debt instrument plus an embedded call option. Convertible arbitrage seeks to exploit the pricing anomalies that are associated with the embedded option in the convertible bond. The usual convertible arbitrage is comprised of the investor purchasing the convertible security and then selling a series of hedges. The primary hedges are intended to extract pricing imperfections in the embedded option and are typically achieved by selling call options and/or common stock. Secondarily, the arbitrager may elect to deconstruct the fixed income elements of the convertible bonds and hedge those risks with fixed income derivatives, including swaps, options, and futures. All of these techniques are quite complex, and to execute properly, they require a more in-depth knowledge of options and other derivatives. There are many moving parts to the convertible arbitrage that not only create opportunities, but can also create risks. Losses can be generated by unexpected changes in the underlying stock price, interest rates, or credit rating of the issuer. Furthermore, default on the part of the issuer would be devastating.